Good morning, everybody. Welcome to the Flow Show. We got there Friday, nearly the weekend. Nearly the weekend. Can we make it to the weekend safe and sound is the question. Morning, Kay. How you doing, mate?
Hey, morning, Ryan. Morning, everybody. Yeah, Friday. Interesting day because it's the one before the weekend.
Yeah, you're going to have to be careful, I think, today. Might see a similar situation to last Friday where maybe the market later on takes some chips off the table again and just tightens up the risk or trade exposure. So need to keep an eye on that later.
Yeah, equity markets are for sure not liking the situation right now.
Yeah. But yeah, we've got stuff to get through before we get to that point anyway. So we shall have a look at what's transpired since last night. Over in China, they kept the LPR rate unchanged as expected. 1 year at 3.45%, 5 year unchanged at 4.20%. Bit of important data out of Japan yesterday. CPI overnight. CPI coming in softer on the main number, 2.8%. They called it the core, but it's looked at, coming in softer there on the headline number, 3% versus 3.2% prior. The core, one of the cores, beat expectations at 2.8%, but confirmed the drop from 3.1%. However, the ex-fresh food and energy core number beat expectations as well, 4.2%, although it was a pip down on the 4.3% from the prior month. So still very sticky inflation there. We get an odd down month, we get another up month. So the key factor is that it's still sitting well above the Bank of Japan's target. That has got BOJ's Ueda just slightly changing his rhetoric on inflation. He was talking mainly about, after the latest reports from Japan, those economic reports from the region, saying that Japan's economy was recovering moderately. But on inflation, he said inflation is likely to narrow the pace of the rise, then re-accelerate, reflecting changes in corporate wage price setting behaviour. So likely to narrow the pace of rise isn't what they were saying previously. They were expecting inflation to fall into the latter part of the fiscal year. So to come down quite significantly, if I recall. But now he's just a very subtle change that now that inflation coming down may not come down as fast as they were predicting. What that means for monetary policy, we don't know. We have good suspicions that they're going to raise their inflation forecasts in the next meeting coming in a week or so's time. And we have to see how high they hike those in the end. But definitely a little bit of a switch in rhetoric there from Ueda. Anything else you picked out from Ueda? It was pretty much...
and I've just posted it in our newsroom. Just a bit of a comment. The lower CPI is also due to base effects and subsidies, energy subsidies coming in. So it actually, I'm not going to say it's the wrong picture, because I mean, if you get subsidies, they are there, like we had in the UK as well. But yeah, the number is lower, but I guess the market knows what it's due to, yeah, I think Ueda is still like one word per one word, preparing us to do something. But is it going to be at the end of this month? We don't know. The rhetoric is likely going to change, but is it okay? Is it enough for the market to change the yen outlook? I'm not so sure, right? Because overnight, then they may say one thing, and the data may mean another thing, and then they come in the market and buy JGBs again to smoothen the rise in the yields. I mean, just put simply, right now, it's still Ministry of Finance against the rest of the world, and we're going to have to wait for Ueda to really bite the bullet and starts to change monetary policy. And then the next thing we will have to monitor is that by how much is he going to change it? If he just goes from minus 10 BP to zero, I don't think the market is going to be very excited. We've seen big moves in currencies unfold when central banks really step on the gas and change a lot. If Bank of Japan is going to start changing 10 BPs by 10 BPs, then we are not out of the woods yet for the yen, I think, compared to what other central banks have done, unless and I reckon it's somewhere in the back of their mind and hoping that the rest of the world actually starts to look the other way for rate cuts. But I mean, whatever we hear from mainly ECB and FOMC, which are the ones we have to compare Bank of Japan to, they are not ready to start cutting, and far from it. So
No.
Still Ministry of Finance versus the rest of the world for me right now.
Yeah, we're definitely not trading monetary policy in Japan right now. There's bigger fish to fry, obviously, going on. But I think you're right, and we've pretty much been set up for it anyway. Everyone's talking about the end of negative rates as if going from minus 0.1 to flat is going to be the de facto move. It shouldn't be too much of a shock now if they do. And that's the way they want it. They don't want to shock the market into anything. And they probably will. They've already half mentioned that even moving to zero is not a rate hike per se. It's not the start of a hike cycle. It's just going to be ending one part of their easing. And that's the way they want to do it. They're not going to want to get on. They definitely won't be hiking 75 pip clips over there unless some form of poo is hitting the fan. So, they might get their rates up to 1.5%, 2%, and it'll be in 10 pip increments over the next 30 years. And it's going to be hard to trade it. But there might be some knee jerks along the way. And we know, although the market may be ignoring the monetary policy aspect from Japan right now, when we get into BOJ week or a few days before the BOJ, that's when we're likely to see any, expectation trading creeping in for that. So, but until then, we keep the news in the background. We know what they're doing. We understand what they're doing, and we know any changes that come, because that will play into trading when we need to trade it. Staying with Japan, and one of the ruling LDP officials, SECO, says that we need more than 15 trillion yen for the economic package and supplementary budget. And of that, 5 to 6 trillion for fighting gasoline and electricity and wheat prices. So again, that's, as Kay mentioned in that news about the inflation data, they are artificially suppressing prices. So when those drop out, then there should be an inflationary impact from that if prices are still elevated. As we know, they extended the gasoline subsidies out till, expected to go out till April, I think was the last call. So yeah, they're still suppressing prices over there. And that creates a bit of a false economy. Anyway, over to our mate Bailey at the BOE. He's been looking into his crystal ball and expects a marked fall in inflation next month. Hasn't said why. We've told you why, because prices got cut for energy this month. So that's why we've been saying it's going to be falling. But he declined to offer that explanation so he can look like a soothsayer when it comes around to pass. He says, further falls, though, are likely to come incrementally after the fall next month. September inflation figures are not far off what we were expecting. Core inflation fell slightly from what we expected, and that's quite encouraging. Pay growth, as measured, is still well above anything consistent with the inflation target. Now, it seems that high pay growth isn't being reflected in retail sales, because they absolutely cratered today, or for September, which a bit of a surprise to me. I thought they might be a bit less negative than the market expected, not by much, but they absolutely fell out of bed. Month on month, down 0.9%, was only expected to drop 0.2%. Year on year, down a percentage point, was only expected to fall 0.1%. That's why the pound is mainly under the cosh today. We'll talk about that in a moment, because we've got finally got a break in euro sterling, which we'll take a look at there. We also had some election news overnight as well. There were two by-elections, which the Conservatives lost by significant amounts. One of the areas has turned Labour for the first time in over 100 years or some such. So there's lots of headlines through the UK press about how bad it was for the Conservatives. There were, I wouldn't call them bright spots for the Conservatives, but there were some items that we need to keep an eye on, or that don't make it quite the landslide as the press are making out. For one thing, turnout was very low. Really, one of those by-elections only got a 44% turnout. For a general election, the average is currently around 67% for a turnout for a general election, so well below that. So a lot of people apparently sitting on their hands, not wanting to vote, or using a non-vote or not voting as a bit of a vote of no confidence in itself. So Labour picked up the wins, which they'll be crowing about. What that is going to cause, and is starting to cause, is some infighting amongst the Conservatives. If something goes wrong, the first thing politicians do is blame everyone else. So Sunak is going to be under the cosh. There's talk of letters of no confidence being put in. We know that drama from the prior couple of years. People in his own party thinking he hasn't got what it takes to get them through to the next election. Whatever happens, at the moment, it's looking like, based on numbers on this one, Labour are an absolute shoo-in for the next general election. And it's going to be very, very hard for the Conservatives to turn that around. What they have got to do is convince a lot of these people who didn't vote, who are just sitting on the sidelines. If they can swing those back into their favour, then maybe they've got a chance. But it's looking very bleak for them at the moment, unless we see the economy doing really well next year. No cost of living crisis, no wars, jelly and ice cream for everyone, bells and whistles everywhere. You can see how unlikely that's going to be. So anyway, that's the news from the political front in the UK anyway. I don't think the market is really trading it right now. As I said, there's other fish to fry at the moment, but that's all going to come into play in next year's election year. Over in Germany, things are looking good over there as well. PPI now dropping again quite significantly as well, year on year, down 14.7. PPI, another negative, or turning negative on the month as well. So some deflationary pressures coming in over there. It's more to do with the lack of activity over there that's the problem. As you can see, you've got some car numbers there, which are down 17.9%. The auto industry, a big one in Germany there. So it's still not looking good for the Germans. We have to wait and see how they fare in some of their other major data points to come. Over in the US, we got some data out yesterday. Jobless claims, really quite surprising. Yesterday, where are we? Thursday, where are they? Up here. So dropping again, under 200,000, 198K. However, just keep an eye on this continuing claims number, because it is starting to tick up a bit there. Again, I don't know if there's some skew in here with the strikers and everything going on over there, but it's risen again. And that's just something that might start to be building. But otherwise, this number certainly plays into soft landing numbers again. Fully fed manufacturing, a bit softer than expected. In the bits and bobs, employment rose, prices fell. So it's a bit similar to what we've seen previously from like the Empire. So still looking good on employment, not big numbers, but it turned positive, and prices easing a bit further over there. Canada too, seeing some price data, PPI as well, a little bit hotter, month on month, 0.6%, sorry, 0.4%, beating expectations. Year on year up as well in the raw materials prices, both higher as well, month on month, year on year. So even though we saw the CPI numbers coming down a bit, the PPI numbers, which can lag some, are pointing upwards as well. US existing home sales coming in, beating expectations, but coming in softer than last month. On the house price front, median prices came in at 394,000, which was down from the 404,000 in August, and also down from a year ago when it was 407,000. So a little bit of price pressure coming in to the housing market from those numbers. Over to the speakers. Fed's Harker, he's been out all week and he's out again today, I think, as well, this bloody Harker. The only thing he said differently, well, not even really differently, he said we're at the point where we can hold rates where they are. He's been a big pauser, but said won't hesitate to support more hikes if needed. Fed's Logan says we're not yet convinced inflation is trending to 2%. So now over to His Majesty Powell and his speech last night that was hotly anticipated. On balance, I think he's done his usual walk a fine line, but he has tipped a couple of little nods to what's been going on in the market. So I picked tons of comments. I've picked out the more valued ones. He says there's additional evidence, additional evidence of a stronger economy may still require rate hikes. So he's doing the usual, give a hawkish line, give a less hawkish line. He says the FOMC is proceeding carefully given the risks and the hikes so far. There may still be meaningful tightening in the pipeline. The Fed has slowed on rates to give policy time to work. I thought that was a key comment because he didn't say the Fed have stopped rates to give policy time to work. Slowed on rates. It's all about the little lines there, the little words. It doesn't know where monetary policy will settle. It is possible that we're going into a more inflationary period, but it's hard to know. It doesn't feel as if policy is too tight right now, and the bond yields rising is tightening financial conditions. He's getting on board that bus that we've heard from other Fed members. He then went on to talk more about yields, saying that the yield rise is not principally about expectations of the Fed doing more. So that's a warning that yields aren't going up on the prospect of more hikes. However, they will be letting the yield rise play out, but then said significant tightening in financial conditions with higher bond yields can have implications for policy, and we remain attentive. So a little bit of a warning there. Overall, he really gave yields the green light to carry on up. He tipped in a little bit of caution to say we're keeping an eye on things, but didn't come in with anything heavy to say it's going to be a big problem at the moment. So yeah, a bit of a green light, though. We haven't really seen markets taking advantage of that thus far. Kay, what did you make of Powell?
Yeah, it's like when you play piano or you learn to play an instrument, the metronome, you know, it ticks to one side, then it ticks to the other side, then it ticks to the one side again, and then back to the other side. The pendulum swings, and he covered basically all bases. It's I'm going to say it is a change in the UEDA style change. Word per word, but making sure you cannot fault him on getting dovish or getting more hawkish. And so he basically covered all bases. There were some positive and or hawkish and dovish lines in there. The market reacted on both sides, and now we are back into the middle, barring the subtleties of each currency. But if you look at stuff like euro dollar, for instance, the biggest pair, we could argue we are trading a little higher than when he started to talk, but it's really we are well within the ranges right now. I haven't seen anything that should have driven the yields one way or the other, but within the whole thing that has been said, we have to note that the inversion of the curve is getting less and less and less. Some have already uninversed. We are waiting for the 210s, which is the main barometer, but we are now like barely 20 BPs of inversion, where it was Armageddon where we were when we were wider than 100 BPs. I'm just noting that regularly this this inversion gets priced gradually out, which is that somewhere the market still feels like it's going to be okay, but but also the 2-year, for instance, which is relatively close to where the FOMC is putting the Fed funds, is not making, well, is not holding its new ground or freshly gained ground. That means that the market is still believing that we're nearly or we're there. And that is sort of what Powell told us yesterday. So I think the market reaction is pretty normal. Well, again, you know, we could sum it all up in 2 words. We are data dependent. And that's where we are at. And that's where they are at as well. They do acknowledge in a way that the market is doing part of their job. But he also said that one of the lines was that markets usually anticipate the events and already trade what's beyond the horizon or expected. So that's where we are now. Yeah, he's a lot less hawkish, which was to be expected gradually, because that's how it should be. But yeah, I think it's all within the normality of what the expectations would be.
Yeah, very much. I'm just doing a look. I was looking at something yesterday. I'm not sure how accurate this thing is. Just in trying to show the yield curve here. This is just based on futures. Whereas we know futures 2 years are trading 5.15, so that's a bit out. But this is just futures prices. But you can see, you get a rough idea of the shape of the curve at the moment. You know, we're getting all this noise around here in the 10 years as well. That's that little tool I found yesterday that I was helping James out with. Might keep an eye on that one anyway. But yeah, it's Powell. He does it every time, doesn't he? He stays one side, he goes the other side, gives with one hand, gives with the takes with the other. I think, as I say, I think it's given yield traders or those who want yields up, it's given them enough of a warning to be cautious, but I don't think it's enough to stop this. This today is going to be important. If we don't break above it today, or even if we do, I'll be worried that move lasts, because we get in, as I said, into this weekend thing like we did last weekend. Potential market risk, might see a bit of a bid coming into bonds yet again. Then it'll be next week as to whether we then go on and get back to things and take it out again. So I think I fear it's going to be another mixed picture today in terms of trying to gauge which way markets want to go. The only real data we've got today coming up is Canada retail sales. That might be some final thoughts for the Loonie to trade on there for August, so ages ago. So yeah, just looking at some of the other pairs, you know, dollar yen, it's tapped up the 150, got to 149.99, then got a bit of a slap back from that. Now, speculation is rife and educated guesses, as we will call them in our chat room, as to what's going on up here. There's a ton of options. The 150 strike is the busiest strike on the ladder out of all the strikes. There's some 9 billion rolling off between now and the end of October. The majority of those options are calls. So in theory, just in basic terms, that gives the writers something to defend because they won't want the price above. But as always with options, it's never just one person potentially who's trading these options. It could be 200 people all with calls, and the writers, it could be 100 different writers as well. They're not all going to be on the same side trying to defend stuff. But anyway, we look at what we've got in front of us. There's a lot of calls at 150. That's a reason to defend it. Kay, no doubt, will explain can explain things in more intricate details.
If I start to explain options, we need two flows because it's all not that obvious. I mean, I've got pretty good experience with options. It's whatever Bloomberg or Reuters or stuff may write, those people seem to me like they have never traded a single option in their life, and they're just trying to put a few pieces of puzzles together and then write whatever they think is going on, because that's not really the psychology of what's going on. Because if that would be the case, it's really trading like a barrier, right? Because if the writers can only defend as much as what they got as a premium, but it's not defending what they do, because they probably are responsible for bringing it up here anyway. Because let's say, for instance, that the option, I'm just going to try and do it in 2 minutes, okay? We trade at 149.5, and you buy an option at 150 or so. And let's just for the sake of the making it easy for the calculations, let's say that it's a 25 delta. So that means that if you buy the option, in theory, you're long a quarter of your nominal when it goes up or down. And the higher it goes, if you buy the option, the more you're going to get long dollar yen versus where you paid it and versus where the price is moving, without really taking into account time value, because that's where I say it's going to take 3 hours to explain. And if you get to 150, your option is a 50 delta. So you're equally long, equally short. But if you're a writer, you are 25% short dollar yen. But if it goes to 150, you're 50% short dollar yen. So the higher it goes, the shorter you get actually in your book. And that's where the comparison stops with what people like Bloomberg are writing. Because if it goes above 150, if you want to defend 150, you are going to actually end up having double positions. Now, you can defend it for as long as you don't spend your whole premium. That means that above a certain level, all of a sudden, this is going to flip around and you're going to get very short gamma and you're going to have to buy. And this is where the comparison with a barrier comes into play. So we have to be very careful when we read what people are writing about it. If it's not somebody who really is an option trader or does it the way option traders do. I mean, I recall I was sitting next to the option desk in banks. I recall how they did it. It's not really the way that people like Bloomberg and stuff do it. But the way that I just said at the beginning, I said the writers are probably responsible for taking it up here, because the higher it goes, the shorter they get. So they can defend it here, and that's why I'm saying it's like a barrier. But they are not going to defend it for more than what they got as a premium. So it's a bit, and then they're counting on the buyers of the options to start selling above 150 because their premium has gone up in the meantime, so they have to hedge a little bit. And this is the way, like I do my options really when I'm trading them in the room. For people who are in the room, that's roughly how I trade it and start to trade around my strikes and stuff. So it's more complicated than what they say, and it's not completely right what they write either. So.
Yeah, exactly. But it is what it is. You know, it's a big strike. It's another reason why something's happening at 150 for right or wrong. You know, we know something's happening up here. It could still be some official offers up here. You know, the dips are getting bought. You know, it's not dipping significantly. This spike here, though, again, to me, is another indication that a lot of longs are nervous up here as well, and they're going to be quick to get out, much like we saw here. You know, as soon as it looks a bit tasty, or maybe someone's fishing around officially or unofficially, they're going to be quick to hit that sell button and get out of these longs, but they're still happy to buy it. So there is something going on up here, whatever it is, whether it's these options are just part of it, all of it, none of it. And that's why at the moment it's such a big level. I have dropped a couple of buy stops in above. I managed to high tick the high in that move there. I'm going to have another go if we break it, and we'll see if we get some acceleration through this time. But if those option lot, if the 150 does break, I should suspect there's going to be a bit of covering going on anyway.
Yeah, I think that it may not go as fast on either side, but as you say, there's definitely interest around the 150, that's for sure. If it breaks that prior high, we're probably going to go for a little bit of a run, but then we cannot exclude yet another move like we've seen. I don't think it's going to be that violent if for whatever reason Bank of Japan starts to call around, or people who are long the options start to trade their delta around. Yeah, definitely it's going to be interesting. But if you look at where yields are elsewhere, it has very little reason for coming off, right? Barring those calling around and interventions, really, it's just too costly to be long yen for longer still. And we're seeing it in crosses, even with the sterling being weak, we are still well above the danger zone in sterling yen, for instance, above 180, 80 and a half. Not to mention euro yen, which is actually breaking back out of the latest box, and stuff like that. It's still too difficult for me to be long yen. There will be a time. Nothing goes in one line, but it's not yet. Not yet, and I think it may have to wait until, as I've been saying already a good few times, until the rest of the world falls apart around Japan.
Yeah, exactly, mate. Right, well, let's have a quick look at the quid. As I said, under the cosh this morning, mainly on that data, and we've got a break above the 87, call it 20 level. It says 17 on there, but that's because it's sitting there forever. So we've had this break above this area. Now, it looks like we've had a bit of a confirmation, got a bit of a confirmation there of at least the 87 area, but we couldn't hold just yet up here, this 87.20. We dipped down to 10. Then went up again. I'm not convinced until I see it starting to hold this 87.20 area. I'm not yet convinced of this break unless it continues going higher. As you can see from the chart, we've run into the 50 fib of the bigger move. Oh, let's get it on there. So technically it's hit the line, and that's the top for now. I think we've got a 40 high in that, so pretty much on the money for that fib level. So now we need to see, we got 20 pips to play with. Does it come back below, or does it hold the gains and keep motoring up? If it does, then we got another zone here, which is a bit similar to my 86, 45, 70 zone down here. This one's, call it 60, 75, 76 zone. As you can see, it's a bit of just one of these traffic areas. Not necessarily something you'd trade against, but I'm looking at it potentially to take some profit in there. I'd like to get a dip to buy and then take profit into there. Otherwise I might leave it till closer to the 61.8 near that big figure. But yeah, this is a bit of a traffic zone here, a bit narrower than the one down here, but I expect it to play ball or at least put up a bit of a fight up there depending on what's going on. Get above there, and then we're talking about 88s, maybe even higher. As we know from euro sterling, it likes to do nothing and go sideways and bore you to tears quite often, and then it makes a move. And when it makes a move, it can make a decent move. Then what happens is you get all excited, and then all of a sudden it dies a death again. But here is going to be a resolution one way or another. If we hold here, then we're likely to take a leg up and maybe set a new range. If we fail here, I fear it's back to boredom and back to these old ranges here. But for now, my longs are continuing. My longs from down at 85 continuing. I'm still happy to stay on the right side of this. As I've been saying, my view on the UK is that if there's a country that's going to suffer more through these rate hikes, it's going to be the UK. And we got a little bit of piece of that in the data this morning. You know, there's no soft landing numbers there in those retail sales, more like falling face first in the mud. Euro, as Kay mentioned, had a little poke above 106 over power yesterday, couldn't hold it, back into the grind. Again, this one's really tight as well, pretty much for the whole of October, been relatively tight. Still looking like it might want to push up, but it's not putting in any great effort on that 106 level again. So we know where the numbers are. When it breaks or when it doesn't want to break, it gets up to this 106.10, 15 area, the level above 106.35. The bigger level is still 107. So this is all still in the short-term noise down here, doing all this. Till we get above 107 and even this 38.2 fib, this trend is still valid. This downtrend is still valid. We're just seeing a bit of sideways going on. It's a little bit similar to what we've been pointing out in the Kiwi. You know, the Kiwi found the bottom, went a bit sideways for a while, couldn't break up, and then it broke down. And as you can see, the Kiwi still holding the break. Got the break, 60, 70s, confirmed the break, 60, 70s. Now we're still walking along the trend line. So there's your playground for the Kiwi right now. Need to get above 58.70 to then start getting back into this zone. While it's not, keeps the downside pressure on. So as I said, just go back to the wider picture, just to compare. Downtrend still well in play. Got to this point, went sideways. Now we're continuing the journey. Same, as I said, might be on for the euro unless it gets back above 107. Dollar CAD's a little bit all over the place at the moment. It's now still deciding what it wants to do at 137. We had the resistance, we had the break, resistance again, now break, but it isn't really holding. This trend line seems to be having a little bit of a say in things as well. So a little bit undecided what this one's doing. Obviously, there's the pull and push of oil going on as well. In that, oil back up again. 1 minute's down, next minute's up, 1 minute's down, next minute's up. Obviously, Middle East tensions are going to be weighing on this. Again, this might be another weekend trade that happens, and we see oil remaining bid going into the weekend. No one's going to want to be sitting on shorts with the possible weekend risk coming up as well. Who was after? I'll let you take that one. Kay, Mr. or Miss Northheimer was looking at Euro Kiwi. Kay, do you want to take over that one?
Oh yeah, okay. I'll show a couple of things.
Yeah, and Paul Stelios is still about. He's just got other bits and bobs he needs to take care of, so he's had to forego the show for a while.
Okay, today a little bit different. Let's look at equities, and the way equities are trading is what we've already been talking about. Is the market going to be willing to be long risk in the weekend? The short-term market right now says no, but we've seen of late that the American market is not always doing what the European market wants to do. So for now, we are below 4,300 in the S&P. Keep an eye on that level for the close today, because it should be your judge to see whether the market wants to go a bit positive risk into the weekend or not. And then we'll see next week, of course. There was a bit of a line out while we were already on the show, saying that there are reports, sources saying that the Palestinian President Mahmoud Abbas is to participate in a Cairo summit for peace on Saturday. So whether that's for the time being keeping the stocks or the risk market from falling further, not sure, but again, we're ahead of the weekend. We'll have to see what the market wants to do here towards the close. There are a bit of OPEX expiries as well, but we never know which side that really sees the acceleration. What was it again? On Euro Kiwi. Yeah, let's have a look at the Euro Kiwi. So this thing, after the breakdown, has shot up from those lows here last week, and we are successively breaking resistances through well, to start through 179.5, then 180, 181, where the 61.8 lies. So this is your level of support right now, but we're really pushing very hard and very rapidly. The Kiwi is one of those that with the lower CPI and a bit of risk off as well, is really under the cosh right now. It completely reversed the picture that the Kiwi had until a couple of weeks ago. Yeah, well, for as long as we are above, let's start by 180.85 figure. And then, but the big confirmation here will be now around 179.75, 180. I don't know what kind of positions you have, of what kind of leeway you have in positions, but for the short term, it should hold above 180.85 figure, and then this could push up into the 182.5, 182.85, where excuse me, a couple of prior highs are situated as well. The euro, as I've been saying regularly, is one of those currencies that when it's risk off in the market, euro tends to strengthen a bit versus currencies which are bigger risk currencies. Okay, so this move, even though quite sharp, is in the trend of things relatively logic. Excuse me. That for the Euro Kiwi. We need to look at gold, right? We need to really look at gold, and we're coming into this zone here, 87, 82, 87. We're in it, where we may. This is the prior high. If we get above, we may have this quick push into and perhaps even above 2000. I've said it earlier in the week. This is a move. Be careful when the market is going into full-on risk-off mode, or we should say war mode. This is the kind of moves that are possible. And on the break of 1930, it never looked back, and we're already $50 higher. So this is your risk move. Now, those meetings over the weekend are putting the risk both ways, but on the ground, it does seem like also with the situation now in Lebanon, with Yemen getting involved as well, where the US had to intercept rockets, it's maybe not yet ready to start correcting, or easing is the right word, on less stress. This is really your perfect barometer for stress that we had here since the start of the events in the Middle East. So these are your levels topside. I think for things to quiet down, first we have to get back below 1950. So it's about $30 from where we are now. I think this is your Thor zone. We can get down there easily if you get some kind of news out, or if yields really break above the 5%. But I think it's more psychological than really a market mover, this one, and I'm taking a risk in saying that. But yeah, I mean, I think it's unnecessary to start to try and find the top here. unless you have the ear on the ground, then you know that the situation on the geopolitical side is improving, which we don't have any confirmation of right now. So that for gold. Silver has been lagging again, but now it's starting to move back up to this 38, 42, 45, 23, 38, 40, 42, 45, the trend line, which is holding. So that's an interesting level here, 22, 65, 70 still. So that's, I think, your range to watch for the day. That's what I'm watching, at least for the day. Just a quick one back on the cable, because I'm in cable right now. I think we're in the range here, and we have to look all the time at what's happening. That's what I'm doing anyway. This is not breaking new ground lower, that is wider. Those are the differentials, yeah? So for as long as this is not breaking lower, then we are going to see those bids below 121, the figure, come in. I reckon what the market is doing now is a bit like I am doing. Get a rally, try to get short, but don't forget to take profits on the low end of the range, or the little bit of a channel. I think for the day, your mini pivot area is around here somewhere, 121.5, 50, 55. It goes back above, then there's a possibility to get back above, back to, but not above, I'd say 122. Everything is possible on a Friday, of course. That's my danger zone for my own position. Been trading it around a little bit, but I think the numbers are shitty enough in the UK to defend a bit of a short position right now. Above here, I will reassess. Euro sterling, Ryan has already said what's going on there. I think it does look like this thing is ready for a move higher. Kiwi, Aussie, yeah, Ryan already spoke about it as well. I mean, the Aussie is doing similar than what the cable is doing. We're getting those tryouts below 63. We moved again marginally below the 63 this morning, but again, for as long as there's not another catalyst, like for instance the US yields flying again, I see it rather going in this kind of line, but with ups and downs. Okay. Kiwi, I need to come back on it because I have the position. I'm a bit short in this animal for as long as we stay below this little broken zone here. It's doing the same thing as the cable and the Aussie. It's trying to, but not yet breaking really down. If it does, though, then I think Ryan was already mentioning those levels of 55s or so, and that looks to be the way this is still wanting to go. But again, I'm not sure we are going to have a sustainable break ahead of the weekend. We'll have to see what we do with this next week. Ali, oh, that's a very short. Yeah, Ali, I mean, I know you're talking to Ryan, but I have the position, so we are in the same position. Yeah, I think your level there of 75 is perhaps a bit, if you can spare the extra 5-7 points or so, that would be nice, because I think the zone here is more like 75-85. But yeah, we need to see this break below. I'm looking at the clock. Is there anything else you guys want to look at just in the last minute? Because I'm not going to.
Well, I can grab it back if you want, mate. And you do that one, and I'll grab it back.
Euro yen. Look at. I think it's when Ryan has his microphone open that I'm coming out. That the echo is brought. So Euro yen is trying to break out of the box here. It did break above the trend line, 158.40. We saw those offers here last time up 158.60s, and it's trying to go now, right? I think Euro is still not the one that you want to be short of if you really want to be long dollars, it's not giving me too much confidence to do euro as such. Back over to you, Ryan.
Thank you, mate. I'm going to grab it quickly. I just want to go back to gold just for a particular reason, because I know gold is looking at a lot of people looking at gold. Can you see my screen okay, mate? Does it come up? Yeah, cool. So, you know, I know a lot of people trade this on the text. I know a lot of people will be itching to maybe short these moves here. This is a good example of learning what price action does. You know, there were two levels that we were looking at for all this time: 1985s, 86s, 1885s. That was the range. Then all this crap started hitting the fan. Okay, but look at what's happened. We came up to the level. What did it give you? 85s. It gave you $17, $18 back. Okay, moved up to the next level, 30s. What did it give you? 15, 12, 15 bucks back, maybe a bit more, 20 bucks back. Then we had a break up through. Got up to the next level. What did it do? Gave you 10, 15 bucks on that. Then it broke up again. Learn this price action, okay? If you want to short a market like this, fine. Touch your level, try a short, keep it tight. $5 over, you're likely wrong. But if it dips, you want to be looking at the prior action. You know, 15, 20 bucks is all it gave you before it went breaking up again. So you get 15, 20 bucks, you take your money off the table, you lock in your stops at maybe at break even or better, just in case it goes back up again. If it carries on going, fine and dandy. Watch for your next levels. So if you want to short markets like this, look for the evidence. Test your levels, but don't test them with big risk. You know, it may be worth having a little short up here. As I say, $5 over, trading through 90s, you're wrong. You don't need to be trading 2000s before deciding you're wrong. But you can also think about flipping your trade into a long, you know, and then you capture the break. So you may have made 10, 15 bucks on this type of move. You can make 20, 30, 40, 50, 60 bucks if you catch the break on the other side. So take your bias out of it sometimes. Don't just be wanting to short something because it's rocketing higher. Take your bias out, trade the levels, trade them sensibly, trade them both ways. You know, you're here to make money, not to trade your bias and be right in the I think. So trade properly, okay? Pick your levels. And then as Brian's going to repeat to me in the chat room later. Anyway, that's that for that. Thank you very much for joining us on the Flow Show this week. Hope you've had a good week and stay safe into this weekend, folks. Keep your accounts safe. And we look at it all again on Monday. Thank you, Kay, as ever, for your valued input as well. Have a great weekend.
Yes.